The recent SpaceX IPO was the largest in history, $75 billion raised in a single offering. The stock went up 19% on its very first day of trading, and by the closing bell, the company was worth more than $2 trillion. This made SpaceX, on day one, the 6th most valuable publicly traded company. Bigger than Meta, bigger than Tesla. Elon Musk became the world's first trillionaire, at least on paper. Now, I have a pretty good guess about what half of you are thinking right about now. How do I get a piece of that? And I have a pretty good idea of what the other half of you are thinking right now. How do I not get a piece of that? One quick thing before we go any further. Whatever your opinions are about Elon Musk, we're going to set those aside for today. No politics, just the data behind IPOs, how SpaceX is changing the rules of indexing, and what all of this actually means for your retirement money. So here are the 3 things that I want to show you today. Why IPOs, as a group, are less than ideal times to buy a stock, something unique that's happening with how SpaceX is getting forced into your index funds, whether you like it or not, and why this is one of those rare moments where having the freedom to not blindly follow the index is actually the more disciplined move. Let me show you. The story you hear about IPOs is kind of backwards. You hear about a hot new company, you picture yourself getting in early, and you see yourself riding it to the moon, pun intended. But stop and think about who's actually on the other side of this trade. The people selling you those shares on day one are the founders, the early venture investors, and the insiders. They are the best informed investors in this company. And they've decided that today, at this price, is a great day to sell it to you. That should at least make you think twice. Now, it starts with the price itself. An IPO price isn't discovered by an open market, it's negotiated. The company and its underwriting banks sit down in a room and come up with their best guess for a share price. And here's the part that's kind of a little sneaky. They often set it a little low on purpose. The first day pop that you often see in the news is frequently intentional, so they get a flashy headline on launch day and bring in the next wave of investors. And knowing this, it's easy to think, hey, I'll just pick up a few shares at the IPO price and capture that pop myself. But here's the problem with that, and it's a pretty well documented one. Those pre-pop allocations are reserved for the bank's best clients. There's a ton of research that's shown that there's an adverse selection problem going on here. The IPOs that are easy for regular investors to get into, they tend to, let's say, underperform. So the average investor with an IPO stock is left buying it on the open market right after the pop at a higher price. And then there's this issue about liquidity that you have to consider. In the months right after an IPO, only a small fraction of the company's shares actually get traded. The shares that belong to the insiders are usually locked up, meaning that they aren't allowed to sell them for a set amount of time, typically 6 or 12 months. This can meaningfully limit the number of shares available for the first 6 to 12 months after an IPO, which tells us that real price discovery, the market actually figuring out what this thing is actually worth once everyone is free to sell their shares, may not happen until many months down the road. So how have IPOs performed historically? Dimensional Fund Advisors studied more than 6,000 IPOs in the US from 1991 to 2018. What they found is that in their first year on the public market, IPOs, as a group, underperformed the market. A portfolio of those IPOs returned roughly 6.9% a year, while the Russell 3000, the index of the whole US market, returned about 9.1% over that same time period. Okay, so here's the interesting part, because it's going to be even more important toward the end of the video. Dimensional figured out why IPOs underperformed. As it turns out, IPOs tend to behave like small companies with weak profitability that are spending money like crazy. Decades of evidence say that those are exactly the kind of stocks that tend to have lower expected returns. So if you hear about a hot IPO, try not to get FOMO. And that brings us to SpaceX specifically. And this is where things start to get a little weird. So SpaceX went public with a $1.75 trillion valuation and immediately ran up past $2 trillion. That's pretty massive. But the amount of the stock that's actually available to trade, the so-called free float, was tiny. We're talking somewhere in the neighborhood of 4 to 5% of all the available shares. The founder and insider shares are locked up for 366 days. So let's think about this for a second. You have what is now the 6th largest publicly traded company in the world, but only a very tiny sliver of its shares can actually change hands. And believe it or not, all of this may actually affect you even if you would never dream of buying SpaceX directly. Why? Because of index funds. This is where things get controversial. Most index funds figure out how much of a particular company's stock gets included in their index by something that's called the float-adjusted market cap. Now, in plain English, this means that they only count the shares that are actually available to trade on the open market. And so this makes total sense. If only 5% of a company's stock is available, the index only gives it a small weight because there simply isn't enough shares to go around. So the index automatically underweights that stock. But not with SpaceX. Nope, NASDAQ changed its rules. Right before the IPO, NASDAQ rolled out what it called its Fast Entry program. A mega cap company can now join the NASDAQ 100 only 15 days after going public, where it used to be a 3-month waiting period to allow for the share price to stabilize a little bit. NASDAQ also reduced its minimum float requirement and created a provision letting these thinly floated companies be weighted up to 3 times what the normal amount would be. Well, that's right. NASDAQ now thinks it's okay for SpaceX to have 3 times the weight than they normally would put in. Why did they do this? I don't know. Maybe it's because they wanted it listed on their index. And so now people who own this index are forced buyers. If there's an index out there that adds SpaceX, every fund that follows that index has to buy SpaceX the moment it joins. And remember, there aren't a lot of free float shares out there, relatively speaking. The index funds are forced to buy, and that pushes the price up. And a higher price means a bigger weighting in the index, which means the funds have to buy even more. And so now you have this snowball effect where the price ends up reflecting supply and demand rather than what the business is actually worth. And so Michael Burry, yes, the same guy that Christian Bale played in The Big Short, has come out publicly criticizing this. So the metaphor that he used was that this process forces a fire hose of mega cap index money through a garden hose of actual liquidity. All right, so how small is this garden hose that we're talking about here? Bloomberg estimated that between the S&P, the Russell, and the NASDAQ 100, they need to soak up more than half of SpaceX's entire public float. And so you can see how you'd run out of shares really quickly. But here's the encouraging twist to this story. Standard & Poor's, the company behind the S&P 500 index, looked at all of this and reaffirmed their rules about adding IPO stocks to their index. Their position, more or less, was that you do not hand out exceptions to your timing, profitability, and float requirements just because the company is really big. So SpaceX will not be joining the S&P 500 until roughly mid-2027 at the earliest. But if you own a NASDAQ 100 fund, well, you're about to own a meaningful slice of a $2 trillion company with a tiny float on a fast-track timeline, like it or not. And so this right here ends up being a great example of one of the few weaknesses of passive investing through an index. Now, I do want to clarify that I'm a huge fan of index investing. I think it's probably the easiest way for retirees to invest if they want to do it on their own. But pure mechanical indexing has a blind spot, and this SpaceX situation just put it under a big ol' spotlight. An index fund is a forced buyer. These index funds have to buy what the index tells them to buy, when the index tells them to buy it, at whatever price the market is demanding. This is a good time to think back to that dimensional study of IPOs. They underperform because they tend to behave like small, unprofitable companies spending heavily. So here's a question for you. What if you could keep everything that you love about indexing, the low cost, the diversification, and the discipline process, but add just a little bit more flexibility? That's the whole idea behind factor investing, the approach that firms like Dimensional use. They're technically not passive investors, but they're really not active investors either. For example, instead of being forced to buy a company the instant it goes public, a factor-based approach can simply wait the 6 to 12 months, let the lockups expire, and let the real price discovery happen and sidestep all of that well-documented first-year underperformance. Factor investing can also lean away from some of these same characteristics of IPOs, low profitability, heavy spending, that tend to signal lower future returns in other stocks. So when a SpaceX comes along with a thin float, a fast-tracked entry into an index, and a price driven more by scarcity than fundamentals, a strict index fund doesn't really have a choice. It has to buy it. But a factor-based approach does not. Instead of blindly following the rules of indexing, it can follow better rules. Now look, I'm not saying that SpaceX is a good or bad company here, but a good company and a good investment at today's price are two completely different things. And the IPO is almost never where those two things meet. Hey, if you got something out of this video, please consider subscribing. I would love your help getting to 100,000 subscribers. And if you need help with your retirement planning, come check out my firm. There's a link in the description. Hey, I want your retirement and your life to be an amazing one. Thank you so much for watching, and I'll see you in the next video.